Good afternoon. I'm Michael Kimmel, RPB's Executive Director, and I'm happy to welcome you to RPB's Spring 2019 installment of our quarterly webinar series. We're thrilled to have over 140 participants registered for today's webinar. In addition to myself and Len Teitelbaum, Chair of the RPB Board, joining us today are David Baskin, Chair of our Investment Committee and President and Founder of Baskin Wealth Management, and Glenn Stout, Managing Consultant at Haylock Security Labs, experts in cybersecurity. One of RPB's most important duties as a fiduciary of the plan is to ensure the security and integrity of your data. Glenn came to us in 2018 when we engaged his firm to conduct a comprehensive cybersecurity assessment and to develop recommendations to improve upon our cyber policies and procedures. The results of the assessment came back, and I'm happy to report that we were already doing pretty well. But as you would expect, this work will never be done. This is why we have retained Haylock, and Glenn specifically, to serve on a continuing basis as RPB's Chief Information Security Officer, helping us to monitor and improve upon our cybersecurity policies and procedures with the goal, of course, to protect your data. Now, before I turn it over to Len, who will review the agenda and provide some opening remarks, a few housekeeping items. First, this meeting is being recorded and will be posted to our website in a few days. We will also email a link to you. Regarding questions, first, thanks to those who submitted those questions in advance. We will address them at the end of the session, as well as those submitted during the session by clicking on the Q&A button found at the bottom of your screen. This could be done anytime throughout the presentation. Len, the floor is all yours.
Thank you, Michael, and good afternoon. Before we begin, I would like to encourage us to have a moment of personally guided reflection on the anti-Semitic terrorism that occurred in California that affects all of us. Shalom. Thank you. Again, let me extend my welcome to you for our quarterly update at the RPB on your pension plan. As we indicated a few months ago, we want to add a topical item to our agenda as an educational process and an updating process for you as our participants and key members of the operation. Michael's already indicated the details on that, and I look forward to Glenn's statements. Now, I think what's important to note that as we come off one of the best markets in our history, clearly what's going on is a very, very appropriate topic. And David, I'd now like to turn the meeting over to you to answer all of those questions. David, please.
Thank you, Leonard and Michael. And, you know, it's a truism in the investment management business that you get many fewer phone calls, questions, and emails from the clients when the markets are going up than when they're going down. What we've seen in the last 6 months is a very total reversal in market sentiment. I'm sure that everybody remembers that going into the end of 2018, the markets in North America were falling very rapidly. Most of the indices were down as much as 20 to 24% and bottomed on December 24th before recovering very slightly by the end of the year. What's happened in 2019 has been a total reversal of that trend. And most of our participants, depending upon what asset allocation they have, will find that they've made money in the low to mid double digits, which is a terrific return over a 4-month period. So naturally, the question is, what happened, what's different, and why have we seen such a radical change in sentiment? I think that if we look at the dashboard on this very colorful slide, it gives us a few hints as to what has happened, but not very many answers as to why. As I just said, global equities have made a terrific comeback, not just in the United States, but worldwide, in developing markets and emerging markets as well. Fixed income, that is to say bonds and similar assets, have strangely also made money, indicating that rather than going up, as you might expect, interest rates going up as you might expect in a strong market, in fact, interest rates have gone down. But perhaps the most striking thing on this chart is the real assets, things like oil up 33%, real estate investment trusts up 17%. What this reflects, in my view, is investors looking for a place to put their money because the bond market is so unattractive with low interest rates. There's a number of things that I think we can look at as catalysts for driving the market higher. Perhaps the most important is the Federal Reserve Bank signaling that there would be no more rate hikes in 2019. This was a radical step back from where we were 6 months ago. At the end of June in 2018, most forecasters expected short-term interest rates in the United States to be half of 1% to 1% higher than they are in fact today. When the market fell in the latter part of 2018, and when we saw weak growth numbers coming from Europe and China, the Fed stepped back its interest rate policy quite radically. And we've also seen similar action with other central banks. So number one, lower interest rates have been a catalyst for the renewed stock market growth. Number two, optimism over trade talks with China and the United States. You will recall that the United States opened a trade war with China driven by tariffs on a number of Chinese products. China retaliated by putting a tariff on some US products such as soybeans. Every week we expect to see this trade conflict resolved, and every week we're disappointed. Nonetheless, there is some hope that that will be resolved. And finally, I would note that growth in key non-North American economies is somewhat better than expected. The Eurozone posted a pretty good number for the first quarter at 1.4%. The Chinese growth appears to be somewhat better than we had expected earlier in the year, and that raises the confidence of investors as well. Could we go forward 2 slides, please? Right. So when we look at the progress in the markets in 2019, what we're seeing is that the more volatile, more growth-oriented stocks are doing much better than value stocks. Typically, we expect to see stocks such as Apple and Amazon and Google and Microsoft, high growth, technologically oriented stocks showing high growth, and that's exactly what has happened. Low growth stocks that provide a little bit of yield, but not very much certainty, such as energy, industrials, and utilities, have done much less well than the high flyers. What else we've seen, of course, is that earnings from corporations for the first quarter, which are now largely in, have been as expected or somewhat better than expected. I mentioned Alphabet or Google a moment ago. It's probably one of the exceptions in that its stock was down 8% yesterday after an earnings disappointment. But Apple was up 7% on a earnings beat, and many of the important stocks have done somewhat better than expected. So if you combine good earnings with low interest rates, that's generally a recipe for higher stock prices. Could we go forward a slide, please? Every time we do this call, we put up this slide of the asset quilt, which shows the return on various asset classes into which investors could put their money. If we look at the 2018 column, which is second from the right, we can see that the most cautious investors did the best, and the investors who took more risk did the most poorly in 2018. So far in 2019, in the first quarter, we've seen, if not a 100% reversal of that trend, certainly a major reversal of that trend. Stable value, which is essentially cash or short-term money, has gone from being the top-ranked asset to the bottom-ranked asset. Core bonds, which were the second best asset class in 2018, are the second worst asset class in 2019. So really quite a reversal in sentiment, driven again by low interest rates and good corporate earnings. Next slide, please. Here are, I think, the key market themes. The thermometers basically tell you whether this is a theme that's becoming more important or less important. So the most important theme we thought when this slide was drawn was a slowing US GDP and an inversion in the bond market. That is to say, bonds with longer durations all of a sudden had lower yields than bonds with shorter duration. If we were doing this slide again, I think we would take the temperature on that thermometer down somewhere around fading and neutral, because in fact, first quarter GDP in the United States came in higher than expected, and the inversion in the yield curve has reversed itself. So a number of things which commentators thought were quite negative have now turned around and are at least neutral, if not even slightly positive. The other one, we talked about China impact and globalization backlash, the one on the right. We're aware, of course, of the election of popularist governments in countries such as Hungary, Poland, the emergence of right-wing parties all over the world who are anti-global in their outlook. Brexit is still up in the air. We don't know what's going to happen there. These are troubling trends. I think that thermometer is in the right place at around neutral. It's not having a huge impact at this time. Next slide, please. So we believe that the US is in a late market business cycle. What does that mean? The United States has been in a continuing expansionary phase since 2009, about 10 years. Growth cycles never last forever. At some point they get tired and they start to fail. Where are we now? Well, we are seeing corporate profit growth somewhere between moderating and falling, and corporations are very good at tempering expectations. And when we say that corporate profits beat expectations, in many cases those were muted expectations, somewhat lower than they were a year ago. We see profit margins at least static, if not falling. We certainly see interest rates falling, and there's very little sign of inflation. But surprisingly, consumer confidence remains pretty good, and credit growth remains pretty stable. So on this graph, I think that dot is in about the right place. It's transitioning from mid-cycle to late cycle. And as the blue writing at the bottom of the slide indicates, there is really minimal evidence to suggest a recession is imminent. Everybody read the headlines about the yield curve inversion. I think that those headlines were overblown. Next slide, please. So to summarize, a late cycle does not mean the end of the cycle, and positive economic data can still result in further equity gains. Again, corporate profits plus low interest rates are the formula for higher stock prices. Right now, we're seeing both of those. However, we have to be cautious. We know that growth stocks have outperformed value stocks continually for 10 years. We don't think that that will continue forever. So caution is certainly warranted. And that's why our tier one funds are very well diversified, are focused on protecting capital in down markets, and perhaps give up some upside in order to meet that objective. Next one, please. So how have we actually done in the first quarter of the year? And let me say that, of course, this slide doesn't incorporate April, But let me say that everybody made money in April as well as the first 3 months of the year. So 12.4% in capital appreciation, slightly ahead of the benchmark. Any quarter in which you make 12.4% is a good quarter. Appreciation in income fund, 8.6%, beat its benchmark by a full 0.5%. Good management there. Again, excellent returns. The income focused fund had a number of components which allowed it to beat its benchmark by a full 130 basis points. These are so-called diversifiers, which we added to give a boost in a low income rate environment. They were clearly very effective in the first quarter. And finally, the capital preservation fund, again, so the stable value fund, which is really a cash equivalent with zero risk, produced a very minimal return. So investors in tier one assets, and this is still about 90% of all of our assets, had a very good first quarter. And the final slide, please. I'm sorry, not the final slide. Deviation is a measure of volatility. Less volatility is less risky. As you can see, even though the capital appreciation fund beat its benchmark, it had considerably lower volatility. The appreciation income fund had volatility equal to the benchmark, and the income focused fund again had lower volatility than the aggregate that it's measured against. So we're fulfilling our mandate here. We're taking less risk, but getting very nice returns on the tier one assets. And now I think the last slide, if I'm not mistaken. Nope, one more still. Up and down capture doesn't really tell you very much when the market is going straight up. And in the first quarter, we didn't have any down months. So the up and down capture really doesn't tell you much because there was no down to capture. But you can see that we were capturing most of the upside. Finally, next one. And finally, the tier two assets. These are the self-directed investments that our participants have selected for themselves. Almost all of these products are index-based products, and as you can see, they're essentially meeting their indexes. The ones that did the best are the ones that you would have expected based on the discussion before, and the ones that have done badly are essentially the fixed income ones. I want to note briefly that the Reformed Jewish Values Investment Fund is gaining some traction. It's still less than 1% of all of our fund assets, but it had a superb return in the third quarter of 13.4%, somewhat better than its benchmark, which was a bit of a surprise, but it didn't cost us any money this quarter to put our money where our values are. So Leonard and Michael, those are my remarks.
David, thank you very much. Before we turn it over to Glenn, I'm actually going to go back a slide because I think it's probably worth explaining just a little bit more about up and down market capture.
Well, so the notion is this: if the market goes up 10% and one of these market aggregates goes up 9%, then it's captured 90% of the upside, which is in fact the case for the capital appreciation fund. If the market goes down 10% and our product goes down 9%, it's captured 90% of the downside. Ideally, what you would like is to capture more upside than downside. But as I said, when the market is going straight up, the downside capture really has nothing to measure against. So I would suggest to you that the down market capture ratio bars, the ones in gray, don't tell us very much in this quarter.
Great, thank you, David. And then the only other thing I just want to make sure folks understand is that when we report returns, we always report them net of investment management fees. So the comparison, what we look at, so for example, on this slide, wait, sorry, too far. Here we go. The 12.4% are after the fees that we pay to the underlying managers to manage the investments for us compared to the benchmark. And that is the case for, and that's a relatively standard way of reporting results after investment management.
Right.
Fees.
One of the things we should also mention is that the benchmark, let's take capital appreciation, the benchmark has no fee. So not only did we beat the benchmark, but we beat it after a fee, which puts us at a competitive disadvantage. but we feel if we don't earn our fee, we shouldn't be there. So this explains it, I think, a little bit better. We've done better than the benchmark in spite of the restriction or implication of the fee.